the end. So I'm going to hand over to the people who know what they're talking about, our key speakers. So I think what the process will follow is I'll call you up, and if you can then, once you've finished speaking, sit in front, and then we can have some questions at the end. So first up, Paul Simpson, CEO of the CDP.
Well, good morning, everyone. It's great to be here. I've been in South Africa about 3 hours, so I'll try and speak coherently. But it's really great to be here at Johannesburg Stock Exchange, one of the stock exchanges which is renowned around the world for taking steps to start to integrate sustainability into the work of the stock exchange. And it was exciting to see the announcements and commitments made in Rio, which JSE was a key part of. So I'd really like to thank JSE for having us here today, and of course for MBI, who have been a partner of CDP for a number of years now, helping our work happen here in South Africa and really driving measurement and transparency around climate change, and as Joanne said, now water. So I'm going to certainly give you more, I think, of a global perspective. If we look at the title here today, I'm not anywhere near as an expert in South Africa as you are, so I'm not going to try and compete on that. And I'm going to talk, I guess, about 2 or 3 things. Firstly, the trends in responsible investment that we see globally, perhaps how they relate to South Africa, what responsible investment really means. I'm going to get a little bit practical, because I think that there's a lot of great conversations about sustainability, responsible investment, what we need to do, but as many as you will know, because I'm sure you're already doing this, the real challenge is in making it happen, right? So what is responsible investment? How do we really make it happen? And I'll give you some examples from our learning on climate change. I personally think climate change has been a lightning rod issue for getting companies and investors to pay attention to sustainability, but clearly sustainability is about a much broader range of issues, and particularly how they interact with each other. And then finally, I'll give you a couple of really my personal thoughts about some of the barriers and some of the drivers to responsible and sustainable investment going forward. Just a couple of things about why the investment community is so important. And a lot of what I say will be around climate change, because that's really my expertise, having spent 12 years working on it. But when we created the Carbon Disclosure Project in the year 2000, we said that scientists are telling governments climate change is going to be a big issue for society. Governments are considering what they should do to protect the citizens. And business was generally saying to government, no, please don't regulate, that will be bad for business, bad for profits, we'll have to move overseas. And this is a deadlock that still exists in climate change policy today. And what we felt is the investment community, remember this is 12 years ago, was absent from this conversation. And investors as owners of companies really had an obligation to become involved. So we went to the investment community and said, climate change presents risks and opportunities to your investments. Can you encourage the companies you invest in to reduce their emissions? Will you shift your capital to more responsible companies? And then they said, no, not now, because what we don't have is the information. And without information, we can't make any decisions about responsible investment and how we can be more responsible investors but continue to deliver returns. And that's really a tension that continues to exist. And if we look in the next 30 years, the IEA, International Energy Agency, says that we need $30 trillion invested in energy infrastructure globally. And of that, around 10 trillion of that needs to be in low carbon, clean technology, efficient infrastructure. Some would argue more than 10, but a third of that. So the scale of that investment is enormous. And as we know from the climate change negotiations and from Rio, that we're only going to achieve this if we have private investment at scale, sometimes facilitated or leveraged by public investment. So if we look at responsible investment around the world, just a couple of charts. This one is from the US SIF, the US Social Responsible Investment Forum, and we can see that assets in responsible investment, in the broadest sense of the word, have been increasing considerably, fivefold in the last 15 years. This is just in the United States. In Europe, Eurosif would say that 17% of all assets invested in Europe are now invested responsibly. And I think it's worth to take a second, what do we mean by responsible investment? Because it's a broad word, it's used by many, and it means many different things to many different people. Traditionally, it would have been a lot about screening, so negative screening, and I think it's fair to say that, South Africa 30 years ago, and the issue of apartheid, certainly in Europe, was a lightning rod for the take-up of what was then called ethical investment. And we've seen this spawn out, and I'll talk a bit more about that in a minute. We also see, Joanne talked about the need for transparency and data to drive responsible investment. And this chart here on the right, it's not very clear, I'm afraid, but it basically shows how Bloomberg, who obviously have an awful lot of data that investors use, have now 5,000 people across 29 countries accessing these millions of environmental and social governance indicators. If we just take CDP data, that's down 1 million downloads of CDP data every 6 weeks on Bloomberg. And what this shows us is that the investment industry, who really are the users of Bloomberg, are really starting to pull off data and use the data that's available. Of course, that data isn't perfect, and I'll touch on that a bit more in a moment. If we look at the Carbon Disclosure Project, I think one thing we see, this chart shows the number of signatory investors asking for information on climate change through CDP, and we can see in 2003 we had just 35 investors with $4.5 trillion of assets asking the 500 largest companies questions on climate change, and now this year we have 655 investors with $78 trillion of assets under management. That's more than half the world's invested capital asking for this information on climate change. So an 18-fold increase in investor interest in climate change information. That doesn't mean they're all using it, but they certainly want the information so they can start to consider it. So why has responsible investment been increasing at these rates? And we could say the growth is rapid, but if you take the 17% in Europe, that means in theory 83%. Is that invested irresponsibly? Well, no one would say that, but that's a question we might want to debate a little bit later. So I think, as I touched on, that responsible investment, or SRI or ESG, so many different names and acronyms that I'm sure you're all familiar with, really started with what I would call the ethical or the values-based investment. I, as an individual, want to invest in line with my beliefs, what I believe in, my morality. I think we've seen a great shift in the last 5 years where enormous amounts of assets have ploughed into responsible investment because they believe that it may outperform. And I'll get into why this is, and I'm sure we'll get into this during the morning, but I think that this is the key question. Does responsible investment rather than traditional or normal investment outperform? Because if it does, you can argue that all investment will become responsible. And there's been a lot of debate about this case, and we can have some of that. We're going to hear from David a bit after me, I think, about the principles for responsible investment, the PRI. But the momentum behind the PRI is enormous, and investors have been saying, of course we want to be responsible, we want to prove that. And it's really driving active ownership from the investment community. So many trillions of dollars of assets are invested passively in index funds, and generally it's quite hard for those to become responsible and engaged. Now, of course, in 2008 we had the financial crisis, as people like to call it. In Europe we feel like it's kind of really still going on. But I think what it has raised the question is that, are financial markets serving investors, and are financial markets serving the citizen as an investor? Because ultimately most of the money in financial markets at the end of the day is owned by an individual person, invested through pension funds or insurance companies. So that debate is not as big as we would have expected given the financial crisis, but it's certainly there, and in Europe and the US at least is a very strong one. How do we change the regulation of financial markets so they serve society in a better way? Of course, the macroeconomic changes, and by that there are many, but the ones I would focus on is that it's become very clear in terms of sustainability that with rising population at 7, and it is going to be 10 billion by 2050. So a fantastic presentation on that last week. Someone who totally convinced me it's going to be at least 10 billion, and let's stop trying to pretend it won't be. That the understanding of climate change, of resource scarcity, and other macroeconomic factors affecting both globally and also locally in different ways is also driving responsible investment and relates to this superior returns. Will my investment outperform because of these macroeconomic, demographic changes going on around the world? Finally, and I think an area somewhat absent from responsible investment is regulation. Certainly in the UK now we have something called the Stewardship Code, which is to encourage asset owners to be active stewards of their investments. We have a review of equity markets. Pension funds have to state publicly their investment principles. So we're seeing an increase in regulation, but we find it tends to lag the leaders in the market. So it's the market that's innovating and driving forward, and then governments come in and say, okay, we'll regulate something, create a level playing field. We think governments could do more. So in terms of outperformance, does responsible investment outperform? Well, we're probably not going to ask that question today. We have to always be very careful with backcasting. But this chart shows, in CDP we measure companies on the quality of their disclosure and of their carbon performance. So we have disclosure leaders and performance leaders, and the blue and green lines on this chart show the top 50 leaders in those two categories from the global 500 companies, and the red line is the benchmark global 500 returns. And what we find, if we look at these companies who are doing best actions on climate change, they outperform the market and provide double the total financial return of the benchmark over the last 6 years. Now, there's been enormous amounts of research done like this. This is just one graph. There are lots of them. Some will also find that it doesn't outperform. So the jury's clearly out. But we are seeing a lot more evidence of this. We produced this graph, but we're inspired by Goldman Sachs to do so because they'd been doing this in Australia. And they said that we know that companies who are taking action on sustainability are generally better managed, and better managed companies are delivering better returns. What we're struggling to prove is whether the fundamental difference between those returns is because of the sustainability actions or the sustainability risks and opportunities that affect the company. But Goldman Sachs said we expect in 2 or 3 years to be able to link those fundamentals to financial returns. So I'm sure some of you in this room have also been looking at this. If we draw on some of the lessons from CDP, we collect a vast amount of data on climate change, both here in South Africa but from around the world. 3,700 of the world's largest companies report to CDP on climate change. And we've always said that the purpose of that data is not just to get it measured and reported by the companies. Now that has a valuable role, that companies start to manage what they measure, and particularly when it becomes transparent, but really to get the investment community to start to use that information in their investment decisions and other activities. And this is just a summary chart of the ecosystem around climate change data and the investment world. And we see that there are a number now of big data and research providers. I've talked about Bloomberg, but MSCI, Sustainalytics, many big firms, Thomson Reuters, now have products in data and research. We see index providers like MSCI, S&P, FTSE and others developing new products around responsible investment, indexes and exchange traded funds, ETFs. But I think we've seen the greatest traction in the last few years from the buy and the sell side. The sell side really producing research and analysis on which companies they expect to do better in a resource-constrained world, a carbon-constrained world, a world that pays more attention to labour rights, human rights, etc. But also from the buy side, how do they take this information and research and integrate it into investment decisions? How do they become responsible owners of capital and engage the companies that they invest in? And I'll just give a few examples that we see around this. these are the kind of 4 areas that I'm talking about that I think there are other areas that are a part of the responsible investment ecosystem, but certainly these 4 we see as really big trends in growth and attention. So I mentioned sell-side research. You will see this around the world. All of the big sell-side brokers are producing ESG research, from Goldman Sachs, Deutsche Bank, HSBC. They're really big houses to many smaller and sometimes more specialist investment houses. This is just a clip of a report by Societe Generale, where using CDP and other data, they're actually making buy and sell recommendations on the back of climate change information. Now that's quite rare. We see a lot of research which says this sector is going to do better, underweight, overweight this sector, but actual buy and sell notes on ESG data are still quite rare. So it was very interesting to see this from SocGen. Now, integration is sometimes seen as the holy grail of responsible investment. Can asset managers and asset owners take the data and integrate it into investment decisions? As I said earlier, what does this really mean? Well, for some it means that more traditional, we would screen out certain sectors, certain companies, but we've seen a trend of new developments in responsible investing over the last few years, where screening has a role and negative screening has a role, but we're moving much more towards, I think, positive screening. So funds just of climate change funds or clean technology funds, environment funds, these kind of things, where they're screening companies that have a positive role. FTSE has an index, where the Environmental Opportunities Index, where to be in that index, more than 1/3 of a company's revenue has to come from a certain sector of the economy seen to be delivering environmental benefits. This graph shows Nordea, a Norwegian and Nordic asset manager, where they assess their funds here, the carbon portfolio of their fund, so the footprint of each portfolio. And here you can see they've got Canadian companies, large cap, small cap, and the neutral benchmark. And you start to see that different indices have different carbon footprints. Now they're assessing this for 2 reasons. One is, what's the exposure of that investment to future climate change regulation, shifts and changes in energy prices, but also, over time, how can they decarbonise their investment portfolio? And we see a lot of asset owners and managers now starting to do this. I think there's someone here from the IFC. The IFC, the International Finance Corporation, have been doing a lot of good work to start to measure the emissions from their investment portfolio. And I think we'll see a lot more of that, not just on emissions, it's one of the easier things to measure, but on a whole range of other areas, particularly water, biodiversity, forests, investors starting to try and say, we have a portfolio, what's the impact of that portfolio? Engagement, so where shareholders, investors are engaging the companies they invest in, has really gained momentum in the last few years. I think it's almost fair to say that the US has led the way here because of the structure of legislation where shareholder resolutions are commonplace. And I'll touch on those in a moment, but we've seen in Europe now a lot of companies, investment firms saying, we will actively engage with the companies they invest in. And I think the PRI has really driven a lot more of this, and I'm sure David will touch on that. That if you sign up to the PRI, you sign up to be an active investor who will engage the companies you invest in. So Robeco is a Dutch fund manager. They're doing a lot on engagement around climate change. Hermes is one of the largest pension funds in the UK. And they have run an equity ownership service which is fully focused on engagement. And I think what we see is that really the separation of ownership and control that is delivered by investment markets has potentially gone too far. That the owners of capital, the asset owners and the managers of the companies have become so distant from each other that sometimes the managers may not be investing the company's money for the best interests of those asset owners. So shareholder engagement starts to bridge that gap again, something certainly that the UK government wants to see, and we see it around shareholder pay, as we do other issues like climate change. So at the Carbon Disclosure Project, we were asked by a group of more active investors to create a vehicle to assist with engagement. We have these 650 investors asking for disclosure, and we were asked to develop something to help with engagement. So we developed a carbon action program where now 95 investors with $10 trillion of assets, so a smaller number of more active investors, are engaging a specific number of companies, normally high carbon emitting companies, to do certain things, to set emissions reduction targets if they haven't already done so, to actually make year-on-year emissions reductions, to consider what emissions reduction projects they could make that would provide a positive financial return. So the left-hand side of the marginal abatement cost curve, and sometimes, depending on the sector, to engage with their supply chain. So through CDP, we collect the data for this, and this just shows a chart of a number of companies and what we're analysing. We're analysing the emissions intensity of the company, their targets, emissions reduction targets. Have they actually made reductions? What's their progress against targets? And investors are starting to weigh up the relative risk and opportunities from the individual companies in their portfolio, and where companies fall below a benchmark, to engage with that company to request improved behaviour. And a lot of investors would rather do that than screen out a company, because as you will all know, in conventional portfolio theory, if you reduce the size of your portfolio, you increase risk, although that's not always the case. Just in the States, I mentioned shareholder resolutions. This chart, actually on 2011 data, but shows that 50% of the shareholder resolutions in the US were based on environmental and social issues. We also see some on the board, on management compensation, etc., but more than 50%. And over 110 shareholder resolutions in the US just on climate change and on energy in 2011 alone. So these investors actually, if you take an Exxon, obviously one of the world's largest oil companies, at their board meetings they will have between 30 and 50% of their investors voting against some of their strategies on climate change and the environment. I mentioned indices earlier. MSCI have a number of global ESG climate change indices, and we've worked with FTSE on a carbon weighted indices for pension funds. These indices take different forms, some of them very specifically focused, as I said earlier, but the FTSE one, for instance, actually aims to match the benchmark of the index, be it the FTSE 350 or the FTSE All World Index, because pension funds are very constrained and want to deliver the same returns as the indices they've been used to investing in, but underweights and overweights companies based on their emissions intensity and perceived risk from future regulation and extreme weather events. So we're seeing various types of indices, and some will match industry benchmarks and some will seem to outperform. So just a little bit on the future, and these are just a few ideas really for discussion. I think some of the barriers that we see to responsible investment can also be the opportunities and drivers, but fiduciary duty, the role of a pension fund trustee to invest in the best interest of the scheme beneficiaries. So when I get my pension fund in 30 years, do I want the most amount of money in a world with climate change and natural resource scarcity and other chaos, or do I want an optimum amount of money in a safe and sustainable world? Now clearly it's in my best interest to have a safe and sustainable world, but that thinking is just starting to translate into fiduciary duty, but still too many pension fund trustees are thinking about short-term financial returns, and that is all they can think about, and that's how they're incentivising their asset managers. So that's driving short-termism in the markets. That's what created the financial crisis, the short-term debt issue, and that is equally going to do the same thing for sustainability. The UK Chief Government Scientist said nature doesn't do bailout, so we might be able to bail out our financial system, but we won't be able to bail out our ecosystem if we push it beyond the edge in the same way we caused the financial crisis. So we need to change the short-termism of markets. That needs a whole reinvention of incentives all the way through the system and will really take some time. One of the barriers that has been there, that to be honest still exists in some forms, is that the quality of information from companies and the understanding of that by the investment community is not always good enough for people to trust that data to make investment decisions. Now, that's changing, and I've put that as one of the drivers, that better information is empowering investors to be responsible and investors to understand where they can match indices or even outperform markets by putting ESG factors into their investment decisions. And other drivers already touched on, really, that this population climate change resource scarcity is going to completely change our economies at a global scale and a local scale. And I think the awareness of that is rising significantly in companies, and we often find that the corporate community, the leaders of it, are generally ahead of the investment community. So there needs to be a much better dialogue between the investment community and the companies to help that understanding in a kind of closed loop. And sometimes we get information one way and information the other way, but we need to get better dialogue between the companies and the investors. So I think as we look forward, we expect to see responsible investment to continue to grow at accelerated rates. If we look at Rio Plus 20, Joanne mentioned it, to be honest, from the government level, there's not a lot of tangible things that come out of Rio that affect investment, other than a clear direction from government that they will seek to drive private investment in sustainability and to find ways to incentivise that over time. And we see the UK government in Rio announced it's going to mandate carbon emissions reporting from next year for all companies on the London Stock Exchange. So we're seeing small things, often at a national or regional level, driving that. But we also saw in Rio things like the Sustainable Stock Exchange Initiative, a real commitment from JSE and others to drive forward the integration of sustainability into the way stock markets work. And I think we'll certainly see a lot more of that. Ultimately, we have to say that really sustainable returns are the only returns worth having, but how we get that integrated into what is somewhat a conservative, traditional investment market is really for all of us to come up with a solution. So I hope that gives you a few thoughts and ideas and trends from around the world, and I look forward to discussing those later.